Good morning, everyone. This is Daily Trade Analysis with the market forecast for today, January 19th. Well, yesterday we basically sold off, and a lot of you may be asking why. Because we got good economic data, we got good BPI, good retail sales. I mean, bad is good, or at least it was good until now. And we basically did a move that maybe you were not expecting. And I have maybe some of the reasons why we did what we did. So let me explain you, or at least provide you my point of view and my understanding of what happened. So regarding the move, we basically denied new highs. We rejected quite heavily on the Nasdaq the new high. This new high was heavily rejected. And if you look at the S&P futures, we did not do a new high. This was not a new high. So if you were trading the S&P futures, you were saved. But I think a lot of people trading Nasdaq was caught into this breakout and then falls and a huge reversal to the downside to finish the end of the day at the bottom. So let me try to explain you on the technical side. Once we rejected this price action, this is the 1 minute chart. Once we rejected this, we basically continue lower until we sat on this 30-minute support that we are right now holding, that is coming from last Friday 13th. So we are now in two options. Are we going up again, bouncing from this support, or are we continuing lower to see 11,300? So basically that depends on two things: economic data, and also this week is third week option expirations. As I mentioned in last videos in this channel, third week option expirations happens once a month on the third week of the month, and it's one of the most important things that you have to pay attention if you are playing options. If we check the S&P 500 these Fridays, tomorrow 20, we can see that we have, let's check it out. We have on the 20, we have max pain 391, and we have 5.3 million total open interest. So there's a huge interest in this week's options. And if you can see, 391 is basically at these levels. So we have big amount of puts until 342. I mean, these guys are crazy. Every 5 points, we have a huge put wall. And then on the upside, a lot of people were buying calls for 400 and also 415. So as I explained in the past, these weeks, this third week option expiration is have a lot of manipulation, because Wall Street don't want to pay any one of these guys. As you need to know, Wall Street most of the options are written by them, so they have a lot of interest on not losing on these options. So they try to manipulate the markets, putting a lot of money into the markets to move or to try to induce some of the moves to either side, to be basically on the middle and not pay anyone, or pay at least the less amount of money to the options players. So this, if you take a look, 391 is max pain. So most probably are we going to bounce between 390 and 400. Being into these two, if we go back to the chart, we can see that the S&P 500 basically did that. We were at 400, we denied 400, and we are right now at 391. So we have this big between 390 and 400 we have this big range below the descending trend line in which we can bounce and we can consolidate until the end of this week. For them, for Wall Street, to not pay anything. Next week, we may continue lower or even break out, it depends. But I think a lot of the reasons why we did what we did in the markets, selling off, even though we received good, quote-unquote, bad economic data that is good for the economy, is because due to manipulation. So be careful with that. If you are looking for continuation to the downside, remember that we might be in this range locked out due to these options expirations. What else we can check? Well, as always, we have to check economic data. But given the fact that we are in this third week option expiration, economic data may not have this big power that it had in the past. And due to that, we have to be more on the technical side, looking charts and looking for options, expirations, instead of looking to fundamentals. Nonetheless, I'm going to explain what is Thursday. Building permits, housing market is quite important. We are looking for a little bit of increase because a lot of people are buying houses due to lower interest rates than before. And a lot of the pending homes that were pending to be built are now trying to be built. So building permits, we might see a little bit of increase, but pay attention to that. And also jobless claims, initial and continuing jobless claims. Labor market needs to chill out. But if you look at this, we are expecting higher jobless claims. As always, jobless claims higher means more people unemployed and more people claiming jobless. So that's good for the Fed. But be careful. We are in a situation in which these kind of fundamentals may not affect the market the way that you think. So you have to start looking at charts and going more on the technical side. I'm explaining to you why we need to touch base on this, because if we are expecting the market to not go up based on option expirations, if we see that these numbers for housing and for labor and employment jobless claims are worse than expected, so basically jobless claims are going lower, that's bad for the Fed, maybe we start accelerating some of the moves that options are maybe hinting. That's what I think is going to happen. So let's go back to the chart and take a look to other assets that may provide some insight. So look at this. XLY did also a big pullback, even though retail sales and the conclusion about retailing sales on these Christmas holidays was that consumer spending was lower. That is supposed to be good, but the consumer discretionary XLY sector fund just sold off the same way the market did. So that's quite interesting. Apple rejected new highs, rejected this trend line. Microsoft rejected. All tech stocks and also the yields were lower. So you have to ask yourself these questions. Why yields are going down and the market is also going down? There's something that is not quite clear. This is not supposed to work this way. And you have to pay attention on why we have these divergences. These divergences are explained, in my opinion, due to the third week option expirations that I mentioned earlier, and also a hint on the valuations that are coming for earnings. So let's take a look at earnings also, the calendar, because we can see that today Netflix is going to report earnings. And also on next week, on the 25th, Tesla. So these big two are going to affect the market on valuation. If you watch the video I have in the channel regarding valuation, 2023 is going to be all about that. Valuation, earnings, and trying to get good deals on these low valuation stocks before they start to recover and to again grow as markets and investors are waiting for. So let's take a look at real quick at Netflix. Netflix is supposed to release earnings. If we check the 1 minute chart, we might see that is after market close. It's actually at 4. So it's after market closes, Netflix is going to report earnings. And if you are waiting for valuation and try to provide some kind of information regarding valuation on these tech stocks that are starting to report earnings, you need to wait for market close. So what's the forecast, I think, for today? We have a big wall here, and also we have this area at around up here should be where the S&P 500, this is the Nasdaq, this area should be where S&P 500 reaches 400. So I think this is the top. So we might bounce off here, try to clear until this pivot, and try again to shorts, to start committing again at these levels. I don't think we are going to repair up here. That would be crazy, but anything can happen. We might see a big bounce off here. I don't expect continuation to the downside directly before doing a pullback to add for shorts. So I think shorts are going to be waiting around this 11,600 RT620. This is last week high. So I think we are going to do something like this. We are starting to bounce. We are going to reach that level, and then we probably start consolidating. So this is going to be a bounce day, in my opinion, to continue in the range of the options expirations, and tomorrow we might see more volatility. We might see some fake outs, but I don't think it's a good idea to start going short again after yesterday's, because I don't think we are going to go lower and then tomorrow start going up. I think it makes more sense for Wall Street to push higher first and then do this fake out to the downside. This will allow more shorts to add to the position and take more profits to the downside. So we remain in this range. This move will trap shorts and then squeeze them for a long move. And I don't think they want to trap shorts, they want to trap longs. And the best way is just to trap the longs that are waiting here, bouncing off this 11,400, and then cut them again when they think we are going to retest this trend line again. So that makes more sense to me, and this is my plan. This is what I'm expecting, and we will see what happens. But price action is first, then the technicals. I explain why I'm thinking what I'm thinking, and then you can take a look to economic data to try to provide you some opportunities on if the convergence is on the same direction of the markets. Right now we are rejecting on the overnight, but we may see we are quite oversold, so I don't expect a big move, a continuation on pre-market. I expect consolidation down here and then start pushing into the open. So that's my point of view. Thank you for your time. As always, if you found this video useful, please remember to click the like button and subscribe to the channel to receive notifications. Remember that I upload new videos every single day for market forecast, market updates, and market recap. I appreciate your time and see you in a couple of hours with the market update. Remember, discipline and risk management are key for success. Stay patient, wait for your opportunities, take a look at all technical and numbers economic data and make your own decisions, digest the information, and of course, wait for the open to do your moves. Stay safe, everyone, and see you later.